All right. All right, Evan. So what's the first question on the list today?
Cool. So we got questions in a few different, I guess, categories, but we'll start off with this first one that's pretty simple and mostly for newer traders is why do we focus on daily charts versus intraday charts? And then how do we set up TradingView to show daily charts, with the proper time frame and the proper time span? If you want to maybe share your screen and show people.
So the second part of the question was setting it up, which is super easy. Right up here, you're going to see the ticker. Third one over, you're going to see this interval where you can do minute. You can do, you can set it how you want. We always look at the daily because most people, so for example, this thing's breaking out, but if we look at a 5-minute chart, this name, it's, you can see these like little bull flags forming, but it's just a lot of noise. Okay, I'm going to buy through 22. There's just not a lot of information. And if this name wasn't breaking out, this thing was breaking down, you might see things on the 5-minute chart that seem like it's a reason to buy it when it's not the case. Like you might have a name that's near 52-week lows that's getting destroyed on the daily, but on a 5-minute or an hourly might look like the cool, like the most amazing, hourly bull flag. But then when you zoom out, you're like, oh damn, this thing's smoked. You're not going to get that, that follow through. So that's why we always focus on zooming out. Everyone often zooms in too much and they form the game plan off of what they see for that day. They don't take the time to step back and look at overall what's going on. So for this BRCC, for example, stock's breaking out, new all-time highs, up, 10 days in a row. If you're in it, it's amazing, but if you're looking at this on a 5-minute chart or an hourly chart, it's going to be very hard to know what price to buy, what price to hold it. So again, look at the daily first. Weekly, I'd say try to avoid because it's hard to really see a lot of the smaller flags in a name that it's often much easier to look at the daily first, kind of find the charts that you really like. And then from there, definitely look at the weekly as well to make sure everything else is confirming what you found. But sometimes with the weekly, you might not be able to see some of the bases and stuff as clearly or flags as clearly as you can on a daily chart. And again, the daily chart, you hit 1 year down here, and that is going to give you enough information to kind of help you justify that where you can make your game plan from there.
Yeah, that's interesting. So yeah, I mean, I always look at the weekly first, but like you said, it's harder to find those perfect setups on the weekly chart. So I'm a lot more lenient when it comes to what I like and don't like when I'm looking at a weekly. So just looking for those clear levels on the weekly chart. And then something to add when it comes to setting up for TradingView, because a lot of people will get confused and they'll click the 1 day down at the bottom, So that row right there is your time span, right? So when you're clicking that, you're telling the chart to show you what has happened in that span of time. So you click 1 month, it's going to show you the last month. You click 3 months, it's going to show you the last 3 months. You click 5 years, it's going to show you the last 5 years. So that's the span of time. And then the top one that you mentioned earlier is the actual time frame. So from there, you're adjusting what each candlestick is showing you. When you have 1 day up top, it's one candlestick represents 1 day of price action. And then you have 1 year at the bottom. Now you're looking at 1 year at a daily time frame, which is the bread and butter of what we really look for. Obviously, you can kind of scroll out and scroll in to see more data if you need to, which I do that all the time. But the default is 1 day, 1 year, and that's the simplest way to go about it.
Yeah, so definitely perfect explanation. Way better than mine was. Thanks for that, Evan.
Yeah. Then we have a question here that's basically somebody was asking about a stock, AKAM.
AKAM, okay.
AM, as in monkey. Yeah. So we traded this a few times, but basically he was seeing that the stock had a really strong move off of support. And then I had mentioned that it needs some consolidation up here, and he's just, he's struggling to maybe comprehend, why not just buy through this 122 resistance where it's at, because it's so strong, when the trend just continue. I know we kind of pointed that out in the pre-market video this morning, but maybe you can go a little more into that and like why we would want to see consolidation here.
Yeah, it's more so just like when the name looks perfect, like it has to continue higher. It's often when it's not going to be the case. So if you think of like this, even though like during this period, this thing was up, and we're looking now at a weekly chart. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 18 weeks in a row, this stock trades higher. Let me move the chart over. So, 18 weeks in a row, this thing goes up. The assumption or thought would be, why would it not continue? This trend has been strong for 4 months. This thing has just done nothing but trade higher. And then buyers get a little tired, sellers have to take over, and that entire move or more than half of the move gets reversed, and it still can't take out that move. And that's just this name consolidating. This name has been consolidating for more than, we're talking a year and a half at this point. So the longer the consolidation period, the better. But you also have to be aware that this thing has been consolidating for a year and a half. So just because you buy it today doesn't mean this stock is going to magically want to break out and go, realistically, another like 30 points higher the day you get in. This name could, still kind of retest, maybe it still needs to battle with this 125 if this is like a true high and this is not just a random wick, but it's just, there's no consolidation yet to really give you like a tight entry that it by all means could just as easily push through this area, but it's kind of a shot where, if you're going to buy it and hope to God doesn't go under the prior low, you're risking $1 or $2, very low probability. Okay, you're going to give it versus 113 or 110 or versus the real pivot. There's not really much there that hasn't consolidated enough yet. And you can find like a tighter entry where for a name that we went over like this morning, this was like one of Cush's ideas. This name has not consolidated as much, but it's we can buy up through 56. We can have our risk versus 53. We can give this risk $2 here and have more probability that the trade will probably work in its favor than with that name that it got up there so quickly. It's like for that ACAM chart wise, it's like kind of right here. Like it ran up already. It's at resistance. We're just going to pretend this green line is resistance. It just got up there. It looks amazing, but it just needs to develop and tighten up and consolidate. And the more it can consolidate, we just wait to buy through that high. And we have like a defined out. And for now, for that ACAM, you have it at resistance, but you don't really have that consolidation at the time where it's like resting before that next run up, because we've seen this name every time it has this amazing run up, it just reverses it because they're just not getting its time to consolidate. The buyers are not trying to hold the name up. It's just they're getting super excited. They're racing to what they think is the finish line, and they're all getting kind of tired and losing their power, so to speak. So great chart, great consolidation, but just needs more time to develop and tighten up for you to find like a proper entry.
Yeah, I agree. Just, usually when I see something like this, it's because the person is a little more focused on what they can make versus what the risk is. And, what I always like to ask myself when I get into a trade is like, okay, well, where do I know if I'm wrong? And the problem is when a stock is going straight up like this is you really don't know where you're wrong because the stock just isn't really, if it comes down, it's not breaking any sort of significant support here. So it's tough to execute these properly because you either end up selling too early or selling too late because you're either trying to hold it for that reversal or you get kind of just shaken out at this first little pivot that's right here and then you miss the real move. So definitely just being patient and really waiting for the setup to really scream at you and show you exactly where you're wrong if it falls.
Yeah.
Next question. Tom gave me this one. Seems like a few people are kind of having some issues with this one in the lower chats, and that's distinguishing the difference between a chart that was a bubble or a stage 4 downtrend. People seem to be getting confused with these. For example, Boeing in 2020, and actually a lot of most stocks, but we're looking at Boeing 2020 during the COVID crash. Like people are seeing that as a bubble pop versus, a stage 4 decline or just a sell-off. So maybe you can go into detail about the differences.
Yeah. So I'm trying to think of like
Nicola. sandals.
Yeah, okay. So really the big thing is just, here we go. So we'll compare NKLA and BA. That'll be like our comparison. So NKLA, a lot of like the real bubble ones that will never see the light of day, it's when they have these dramatic moves, very short period of time. And you can even think, and it doesn't have to be like 4 days. You can think of like, even Tilray kind of had, I don't think it was as.
Or that was the weekly. You're looking at weekly, so
Oh,
yeah, it's it could take a few weeks, even a few months to really like explode.
Yeah, even like GoPro is another one that had like maybe 6 months where I know these charts are all over the place. Hold on.
Yeah, if you click auto on the bottom right, you'll have it sized properly.
Okay, here we go. So with the bubble stocks is you're going to always see this dramatic run up in a very short period of time. Call it under a year. So this was June to October. 4 months. Tilray. Let's do Heaven's little auto feature. Same thing. Let's see here. This is July, August, September, 3 months, 4 months. NKLA. Everyone love this garbage company. Let's see, April, May, June. So 3-4 months. So you're going to see an overall theme of, King Ka, the Six Flags roller coaster, where the thing just goes straight up and comes right back down. That's like a bubble chart. It's very quick. It's very exaggerated. The move at the end is the most extreme. And that's, of course, when everyone's often getting in. No one's buying this thing at $10 or $20. They're buying it at 50 and 80 and 100 when everyone and their mother is telling them to do so. But you have that extremely vertical run very quickly, a month, 2 months, couple days, and then it just comes right back down in the same. The come down often is much slower, as you can see. Even you think of like kind of GME and some of these other like meme stock names that like just idiots are buying these, but goes up 1,000% in a week, reverses the entire move in a week. That price action, that percentage change, the stock is just forever dead. It can have these little pops, but you can continuously see it's just lower highs. So it's just like this overall crowd of people, just like you had everyone in the world in at this time, they're getting out, smaller might be getting in the next time, and it's just dies a slow death. And it's kind of the same with all these names. You see the major run up, and then you get these like little spikes, but the same overall trend of just putting in lower highs and lower lows, and they're just dead. With Boeing, on the other end, this name has been trading for years and years and this was like a huge. We're talking about consolidation. This consolidation before this breakout was for a couple of years. This is a 4 or 5 year consolidation. So for the person who was like impatient with ACAM setting up for a year, this was nearly half a decade Boeing flagged before it was ready for this monster move. Even if you think of a name like Microsoft, an even bigger consolidation, I might have to put like a monthly up. This was like a 20-year, it was a 2-decade consolidation that Microsoft was, a sub $60 stock for 40 years. And then once it finally cleared that high, again, this almost seems like a little kind of bubbly, looking at just how insane and vertical this move is, where once you start to, I'm not saying Microsoft's a bubble, but once Microsoft starts to take out 260, and these are monthly, so it's not going to happen very quickly, there's nowhere for this thing to support itself. There's no real out. Even a 50% retracement of this is back to 150. So that's when you see these names that get so vertical. Once that steep uptrend breaks, there's just no one there to really like step in with like any conviction and want to hold the name, because it's just so vertical. And that's why you see like these Tilrays and whatever, there's no support. It's purely just people climbing on top of each other. And then when the first guy is no longer willing to climb on top, everything kind of comes down. So for Boeing, this was like, you can see how long, again, this is a monthly. This was up here for almost 2 years. It was up here flagging. So it's much more defined, where you kind of know, we're talking in hindsight now, but you had a much more clearly defined break of support, that it wasn't this parabolic run up very quickly and this parabolic drop even faster. This was a multi-year base to a multi-year breakout to another base. And then of course we had the pandemic and, black swan type events that ways that Boeing didn't handle, their own internal issues the best, that will probably never, like Boeing will never be like a leader that it once was, because it's hard to like bring back their reputation after after some of the things that they've done. But that's the main difference. You're seeing like the clear consolidation and the time it takes for these patents to develop, that this isn't really like a bubble. Boeing is going to be a $400 stock anytime soon. I mean, in reality, it could take a year or two and it could get back there. But, I'm not going to bet my life that Gmail will ever be a $500 stock again. But like, this is a name that's it's just a dead, these bubble stocks, these Enclays, all these companies that don't do anything. That they're hyped up names with no real business. NKLA has never produced a car. GME is a bankrupt video game company that got short squeezed and somehow is still relevant. AMC, bankrupt movie theater. GoPro, another bubble stock, was a consumer discretionary product that once every kid had a GoPro, didn't need it anymore. So, but at Boeing, if you're flying on Delta or United or any of these airlines, like, you're going to be on a Boeing plane. So it's hard to make the case that like a stock like Boeing is a bubble. Maybe the chart is pretty banged up, but the company, you're still going to see the planes in the air every day, where you're never going to see whatever Nikolai electric car. You'll never see it. You'll see that guy in prison, but you're not going to see that car on the road. That's where those bubble stocks come, because it's the new thing. It's going to take over the world, and people move on to the next thing. Where you think a few years back it was weed stocks. 5 years ago, weed stocks were the biggest thing in the world, and now they're all penny stocks again, because you went from weed stocks to whatever the new cool thing is. And we see this much more accelerated now. Like now it's probably NFTs, where that's the new, oh my God, this monkey is so valuable, I need it. And then in a year, you're going to wonder why you spent 200 grand on a screenshot. But that's my take on maybe the bubbles versus, just beating up stocks.
Yeah. I mean, so yeah, I think the quickest way to really tell the difference is how did the up move happen? Like if it's obviously a solid company that's been, increasing over the years and getting more expensive, and then all of a sudden just has like a quick sell off like Boeing, like that's not a bubble popping. And you also have to keep in mind, like, you have to kind of realize what companies you're talking about. Like Boeing isn't really going anywhere, even though they're, down huge. Boeing's not just going to disappear. It's not just some like fake company. Microsoft, same thing. Even if it did come down 50%, it's a real company. Like it's really doing things, and it's been around for a long time. So these bubbles are usually happening on newer issued stocks that, like you said, go through some hype with really no real reason, quickly go up there and then very quickly come down and never see those highs again. So that's an example of a bubble.
One more thing is, especially on like the percentages, and you mentioned it a little bit before, where with most names, and we saw this a lot with like a lot of the high beta tech names recently, that there's usually like a percentage that the stock can pull back, that it's like still like not fully dead. And you'll see names like, even like Shopify, this was like a 60% drop off its high. And normally it's kind of like 75%. With a lot of these like higher growth names, you should expect, when they're up huge, at least a 79% haircut that can realistically happen. And we saw this now with a lot of these names, that it seems more obvious now. But when you get to that drastic of a drop, there's still a little bit of a chance. When the stock starts to get into the same as 90% off highs, it's 85% off highs. It's so, that extreme of a drop, it's very hard for those names to ever come back. And if they do, it takes years and years and years, where, 50% drop, 30% drop, even 60% drop. Like Boeing realistically could have a couple good quarters and, pay the fines they're going to have to pay for, a couple of those accidents. That news kind of gets out of the way. And this is 100% move from here. This isn't that unrealistic for it to get back to its prior highs. If you bought it today, back to its high, it's 100%. If you bought it today and went back to its low, you lose 50%. The realistic percentage returns. If we look at Nikolai, for this name to get back to its prior high, this thing needs to increase by 1,000%. It's highly unlikely. That's a dramatic percentage change, where just buying it down here and it goes back to its recent low, you're losing 50%. So that's where it's like, this name is down 90% off highs. It's been as low as, if it was at 100 and it went down to 6, it was as much as 90%, 5% off highs. Those are the ones that are dead. That's even like, you think of like a GE, that they reverse split their stock to make them like look, more appealing. But this is a stock that's still 90% off highs. Like, it's just Citigroup. You will never hear me ever on Trader talk about Citigroup to buy it. Thing is, still after the financial crisis, a decade later, 90% off highs. We'll never touch it. But you look at like a Goldman, they've reclaimed and gone to new highs. So these are names where they're 90% off highs. They're never going to come back. I don't care what what your personal opinion is. It's not going to happen. And I've been in names like that where they never see the light of day, and you just waste years and years trying to.
Yeah. And I mean, and even to add on to that, it's like that small 1 in a million chance that it does go back to highs. There's actually a much better trade breaking through those highs than trying to hold at the bottom and swing it all the way back up. So like, if that were to happen and that 1 in a million shot, I mean, even like recent IPOs that kind of fall for a while, you have a much better opportunity when they actually get back to that level. And set up for you, and you'll actually, have a much better risk reward than trying to buy at the bottom and getting shaken out at some point.
It's like, even with like trying to bottom pick that, it's like no one's really, but even like this is one of Cushion Cities. This was like the best recent IPO set through this high, but this was a name that got destroyed. It's like a $2 stock.
Yeah,
and it's like, even if he was buying this name at 2, there's like a very little chance that he, not saying anything about him. Even for me, if I bought this at $2, I'm out of this thing at 5 or 6.
Yeah.
Like I'm rocking with this thing back to 36. And the thing is, like, now 35, like this will have the easy move back to 70 much quicker than sitting through this nearly bankrupt company, which I don't think that's the person's question, but it's just like a common thing where when you look at the chart now, you're like, oh my God, if I bought this thing at $3 and held it a year, of 1,000%. But you look at the stock like here, you don't have the mindset of this is going to go back to 30. It's like, can I buy it at 3 and sell it at 5? That's like the realistic thought for most people, that, it's just so much easier just to focus on the non-bubbly names. If none of your 10 friends are buying this, whatever it is, they're probably late, and it's probably going to be in a void.
Yeah. All right, moving on. Next question here from Nico. He says, if I have a losing position that comes to an important resistance level and I would be break even at that point, what's the most recommended way to handle this if it breaks that resistance? Sell for break even, hold. So the one that he's looking at is TTD, and he's in from 86 from a couple months ago.
I don't know. I had it typed up for you. Even said it.
Okay, perfect.
So I kind of know your cost basis a little bit of where you're at in the name, and now it's the voluntary round trip. We put a couple less on that. And again, I did the same thing with Oxy, and I'll talk about my own mistake, which is a little bit more relevant and we'll go back to TDD. But this was a name pre-pandemic. Was buying these energy names like in this base, and I forgot to put a stop in during the pandemic, and the thing got destroyed during this little drop. Like I was buying like up through like 42, and then this happened, and I got to sit with this, and that's my own mistake. And this thing got destroyed, dropped 80%, took 2 years, and slowly got back to my price. And this was, me internally knowing that there's more of a chance this name will go back to its prior all-time highs, being 100, then it's going to go back to its all-time lows, given how it's been trading. But I've been in this name for 2 years, and I'm just like done with the name. And that's with a lot of those, like what I was saying before, like you can buy it at that best price in the world, but you're not going to have the patience to hold it for a half a decade or longer to fully capitalize it. And I still bought Oxy down here. I was still dollar cost averaging, very light. But when this thing finally got closer to my price over here, that's when I had to I knew that the name was working itself higher, and I had to really just give it time. I couldn't have a perfect stop under 37 and trade it out. I had to give it some time, and I didn't give it enough time because we caught this, when energy got really crazy, we caught this amazing 3-day move. And I'm like, all right, this is like a gift. Like, let me just take this off, take the, whatever it was, 10 or 15% getting made in the name when I was down to 80. but let me just book this now because I feel like a moron if this fully reverses it, it's back at 30 in a week or two. And of course, I got out too early, and I could have, again, we don't care about should, could have, would have, but this would have been a much different trade. Still not anywhere near a good trade risk reward wise, but I was too eager to get rid of it because it was now above my cost base and I couldn't wait to get rid of it when it was probably going to go higher. And then that's exactly what it did. So with like TTD, it's hard to say that like the proper pivot right now, and the fact that I'm in it, it's much easier to say. It's like, yeah, the proper pivot's 50. Again, that's a big percentage difference from where it is now. But if your cost basis is probably somewhere here in the 80s, realistically, the name chart wise still looks very healthy. Like this is just a big range of trading in. But who's to say in 6 months we're not waiting to buy 100? Like this thing has earnings, caps up, it fiddles around this $80 area, comes back into 60, does its thing, gets back to 100, and we're all like salivating for this $100 breakout. And that's a realistic thing that can happen with this name, but you're only just trying to get the money back when a lot of the worst part of it is probably behind it for now. That took out that put in a new lower low, but it's working its way back up here. So that's going to come to your own kind of conviction. Again, if it gets back up to your price, and it goes back up to 85, until it's roll back over, I would understand it and would have done the same thing of kind of taking off break even. But then you have to be aware that when it gets back to 100 or 110, like you have to live with that and just say, like, even for me, Oxy, like I can't really be pissed because it's like in that moment, I knew, I've been in this game for a long time. I know it's probably no higher, but I'm just emotionally done with the name. I just want the money back. I want to put it anywhere else, and I don't care. And I know that's not the best way to trade it because I'm not a robot, but it is what it is. So with some of these names, more so, this was more like a question I think that you might have learned also with using more of M1 that, and I had some discussions with members where if you're up a lot in the name initially and it starts to come back down to your price, I'm with you lowering the allocation and stepping aside. Then it's long-term, I want to hold it forever. But in the beginning, if you initially buy it and you're initially wrong, you kind of have to sit with a little bit because then it's going to be too much. You're doing then too much on M1, and it's going to be more harm than good. So again, short of it, it's coming back to your price. Be patient with it. If you feel you want to just get out break even, understandable. But the more time you're going to give this name as it's getting closer to your price, the more likely it's probably going to continue that trend higher. And it's just how long can you sit with it to take advantage of it or not.
Yeah. And I mean, I think if you're really torn between selling it or holding it, sell half. That's always like my quick solution to those psychological dilemmas of like, should I hold this thing or whatever? Sell half. If it keeps going, you got half your position. If it falls back, you have half your position. If it consolidates and sets up, you can buy again. So it's that's always kind of the easiest way to get a lot of weight off my shoulders. But if this is in your active account, of course, the lesson here is respect your stops so that you don't even get into these positions in the first place, so you don't have to deal with these kinds of things because we kind of forget how these things feel. And then all of a sudden, we forget a stop, like Ben did on Oxy and all these kinds of things. And then it just reminds us like, okay, that's why discipline is really important and sticking to those rules. And all those times that you get shaken out and you're super pissed, you got to remember that other side. They're like, okay, well, my stops do save me big time, way more than these shakeouts hurt me. So, if it's tearing you apart, sell half, Nico, and you'll be fine.
Yeah.
And that was the last question. If anybody in the chat has anything that they want to put in, we got about like 9 minutes left. Anyone wants to type something up? Ben, if you were seeing anything from anybody?
No, not really. I think everything was just, with those losses and even on my end, and with Nico, like with the discussions that we've had, where in the beginning you'll get stuck in a couple of names, and it takes you a year or so to figure that, learn that lesson the hard way. And as you start to learn that lesson, then the next time around, when I like this name for whatever reason, that's great. But when it starts to come back to my price, it's so much easier to take that loss, even if it gaps down a little bit and it's like more than you can stomach. If it's doing that already, that drop is going to be much more aggressive. And I think even for me, for like the pandemic, I got stuck in Oxy and I'm still in Schlumberger. I'm still stuck in this one. And Schlumberger is just one of those like laggards of the names. Like it's, I think my cost basis is like 48 in Schlumberger. So like for me having, being fully invested in the market pre-pandemic, I pretty much only got stuck in two stocks, Schlumberger and Oxy. And two that, they both dropped dramatically. These were not easy drops, but these were not ones that I was going to like get scared out of, because I did this in 08 and I bought Bank of America, and I bought Citigroup, and I bought General Electric, and I bought American Express and Siri and all those names, and watched them drop 95% and sat with them, and they eventually in years they all worked themselves out. But had I had protective stops in all those names, I could have avoided the 2 years of watching the portfolio drop 90% to get back to break even, to then sell them all, and then to watch them now go on the fastest run up to their new highs with me kind of holding the bag. So that was like for this next major kind of black swan event of the pandemic, I got stuck in 2 names instead of getting stuck in 12 names. And that's where you might have learned this lesson harder this first time, but you'll get out of a lot of those positions. You'll get out some break even, they're going to continue higher. You'll get out some for little losses, you'll get out some for some gains. But it'll be like a year-long lesson that going forward next time with these ideas, you'll be better prepared. You'll be much easier to cut those losses. You'll know that, oh, damn, I remember this happened last time. And we're always going to, I say always, but we're going to get stuck in positions. But when you can remove the emotional aspect, like, when I was down 90% or whatever it was in Oxy, and people were like wanting to short it, I think even like Django was shorting it. It was like, I was like, don't short it. It was like, sure, do your thing. I don't care. Like, I know my position. I know that I'm in a bad spot, but it's not going to, negatively affect my day. It's just a mistake I made, and I had to learn from it, and I got the money back, and I made money from it. So you don't want to just make those mistakes and make them very costly by like not having the, like, I know me and you, Nico, we had a lot of discussions where it was like, without them, maybe you would have done some things that maybe would have been more costly. That to talk it out, you can figure out like a better game plan than keeping it all in your head and trying to figure out what to do.
Yeah, I think that's huge. I think that's kind of the benefit of being part of a trading community, and take advantage of that, as we have some really skilled traders who have been through a lot of things and experienced basically anything that you can experience in the market. Somebody in Trading Experts has experienced it. So talking it out with people and just getting your eyes off the chart and more, just speaking with somebody can help a ton too. So
yeah, great. All right, guys, I think we wrapped it up. I don't want to just keep you guys here just to aimlessly chit chat. Just thank you guys all for coming. Gabriel, I can't believe you didn't have like a crazy like discounted cash flow question for us that we would not have the answer for. But I know we'll be doing a review, you and me individually, later this week, so we'll dive into it then. So good talking to you guys, and we'll see you guys soon.
Later, guys.
See you later.